One of the biggest questions is whether after 5 years since the crisis was really at its worst, we've managed to get something like a sound financial system. That's the way I presented this debate. We had Douglas Flint from HSBC and Anthony Jenkins from Barclays saying that they were much safer, and Paul Singer from Elliott Management, a hedge fund, and Anat Admati from Stanford on the other side. We got a really vigorous debate. The main points made by the proposers that they were safer is that we've had much more capital in the system, that incentives have improved dramatically. People are much more aware of the risks, both for the firm and within the firm. They've also made the market infrastructure much sounder and safer. Against this was a strong argument that derivatives remain essentially under-recognized on accounts. There's much more leverage in the system than people realize. The bank accounts are still very opaque. They're still very dependent on short-term funding, which can dry up. The liquidity risk remains the same. So though we've made them somewhat safer, as Anat Admati put it out, it's like saying you've got trucks running through a residential area. They're moving now at a speed limit of 85 instead of 90. My own personal view on this is that of course there have been improvements, but given that 5 years ago we were in total meltdown, there surely had to be. But it's very difficult to believe, looking at the risks in the world now, that what is still a very thinly capitalized financial system is robust enough to stand the shocks, particularly given the scale of the damage they can do, which we now know if there were a crisis. So I would have voted with the opponents of this motion, but I would have discovered, not to my surprise, that in the Davos community at least, I would be in the minority. I attended two sessions with the Japanese Prime Minister, Mr. Shinzo Abe. On the economic program, really nothing new. I personally raised questions about the structural program, whether that would really transform Japanese development in a profound way. There's a long list which I know, but it's still very difficult to believe that Japan will achieve its structural economic targets. But the more interesting part of the discussion was a series of questions, particularly from Chinese journalists, focusing on relations between Japan and China, on his visit to the Yakasuni shrine, which is very controversial, also criticism from journalists from South Korea. And what was disturbing to me is he gave, of course, a very strong and purposeful defense of what he did. He indicated very strongly that Japan, of course, wanted peace, that it was utterly committed to peaceful relations, and that he went to the shrine because of the many other people, apart from war criminals, of course, that were enshrined there. But the most disturbing thing is that he, in response to a question, clearly did not rule out the possibility of a conflict with China. That he felt that was conceivable. He constantly referred, in fact more than once today, to the First World War, to the conflict between Germany and the UK in the First World War, and he stressed particularly that they traded very freely with each other. Nonetheless, they came to war. And obviously the warning was, well, this could happen between China and Japan. I found this far and away the most disturbing experience, in fact, I've had in Davos for many years, and I think it's a very sobering one. Martin Wolf, Chief Economics Commentator, Financial Times, Davos.